This LOS is describe how the choice of depreciation method and assumptions concerning useful life and residual value affect depreciation expense, financial statements, and ratios. Okay, we're going to continue with depreciation and amortization of long-lived assets. In this slide, we're going to look at the impact on some income statement and balance sheet items and ratios comparing the straight line versus the accelerated method. So recall the formula for straight line depreciation expense is cost minus salvage divided by the estimated useful life. Okay, so the important thing to point out is that the salvage value, residual value, and the estimated useful life, those are both estimates, okay? And they can change. You can change your estimate later on. And to get a rate using the straight line is just 1 divided by the useful life, okay? So if the useful life was 10 years, 1 divided by 10, it's going to equal 10%. That's our rate. Now, accelerated depreciation, the way that we remember, there's 2 steps. First, we have to calculate the rate, and then 2, we need to apply that rate times the net book value. Okay, the net book value at the beginning of the year times the rate. And how do we get the rate? It's 1 divided by the useful life, so it's the same here as the straight line, but then we just multiply by 2. So again, if we're using the 10 years, it's 1 divided by 10 times 2, it's going to equal 20%. Okay, so you can see that the rate is higher. And the thing to remember is that we don't depreciate past the salvage value. Okay, to get our expense, we're doing net book value times the rate. We're going to have a depreciation expense for the year, but we need to check that we don't depreciate past the net book value, the salvage value. Okay, so we can see that from this quick little example that using the accelerated depreciation, that our depreciation expense is higher. Okay, so if our expense is higher, then our net income is going to be lower. And that says the early years are growing firm because, as I said, in later years, if you're fully depreciated, in later years, we may not have a depreciation expense using the accelerated. So that's the important thing to note. So again, if that's what's happening, remember I like my T accounts. We have debit depreciation expense, credit accumulated depreciation. Here's our cost of our asset. Here's our accumulated depreciation, which is a contra account, and here's my depreciation expense, okay? So just a quick reminder for people that are learning accounting for maybe the first time. Debit depreciation expense, credit accumulated depreciation, that's a contra account. Cost minus accumulated depreciation is our net book value, okay? So you can see here with our accelerated depreciation, if we have a higher depreciation expense, we're going to have higher accumulated depreciation, and therefore the value of our asset is going to be lower than using the straight line, okay? So again, getting back to our accounting equation, assets equals liabilities plus equity. If our asset is lower, what's happening? Our equity has to be lower as well, correct? Assets equals liabilities plus equity. That's easy to kind of understand. If our asset is lower, our equity is lower. Why is our equity lower? Because we have lower net income because of the higher depreciation expense, okay? So the return on assets and return on equity, that's easy to understand. As goes our income, so goes our return calculations, okay? And that star there is just, again, reminding you that that's in the early years. Our turnover ratios, remember what our turnover ratios? It's sales over assets. So if our assets are higher, okay, then we're going to have a lower turnover ratio. If our assets are lower, we're going to have a higher turnover ratio. And then with regards to the cash flow, that's important. Remember, depreciation expense is a non-cash item, so our cash flow is exactly the same. As I mentioned, salvage value, a residual value, and useful life are both estimates, and those estimates can change, and we can adjust our depreciation expense in later years, and that's something that we see in another LOS in the CFA program, okay? And so changes in salvage value and useful life both represent changes in accounting estimates. And what do we do for accounting estimates? We don't need, it's not a change in a policy, we don't need to retrospectively restate, we just make the change going forward, okay? And so given longer useful life or higher salvage value, if we extend the useful life, our depreciation expense is going to be lower. Lower depreciation expense is going to increase our earnings before interest and taxes, our net income, and our ROE will be higher. Shorter life or lower salvage value has the opposite effect. So it's important sometimes to look at the estimates or any changes in estimates, and that's one issue that can come up with regards to managing earnings, is that suddenly you could have an estimate that you're extending the useful life of your equipment, you're lowering your depreciation expense, and you're beefing up your earnings a little bit. Here's some information regarding component depreciation. Component depreciation involves depreciating an asset based on the separate useful lives of the asset's individual components. So what would be an example here? An airline, an aircraft. An aircraft has very, very expensive engines, and those engines can be upgraded and replaced over time. So for example, with regards to the depreciation of an airplane, you might have a different depreciation rate on the engines versus the rest of the plane, an individual component, okay? So that's required under IFRS, but it's permitted under US GAAP, but seldomly used. So the issue here is the firm must estimate the useful lives of each component and depreciate it separately. So you can imagine that's just adding more complexity, it's adding more calculations. So it's permitted under US GAAP, seldomly used. I have an airplane, it's good for 20 years, etc. Not looking at the airplane while the engines are replaced every 10 years, but the airplane is going to be good for 20 or 30. Okay? A practice question to check our understanding. At the start of the year, a company acquired a new equipment at a cost of 50,000 euros, estimated to have a 3-year life, and a residual value of 5,000 euros. If the company depreciates the asset using the double declining balance method, the depreciation expense that the company will report for the third year is closest to A, 555 euros, B, 3,328 euros, or C, 3,705 euros. Okay, this question is not too difficult. It's just a straight out calculation using the double declining balance, but we need the depreciation expense for the third year, okay? So we can see here we set up our little table, year 1, year 2, year 3, and our depreciation expense, recall, for double declining is the net book value at the beginning of the year times the rate, okay? That gives us our expense for the year. And how do we calculate the rate? That's the first thing that we have to do. It's 1 divided by the estimated useful life, which is 3 years, times by 2. So if I bring up my calculator here, that's going to be 1 divided by 3 times by 2. You can see that we're going to have a rate of 66.67%, okay? So if I multiply that by, at the beginning of the year, first year, it's going to be 50,000, which is the book value. I'm going to have a depreciation expense of 33,333. We can see we're rounding it a little bit. So if I make that a negative and I add my plus my 50,000 at the beginning of the year, you can see that we have a net book value of 16,666.67 at the end of the year, okay? So that becomes my beginning balance for the start of the year. And net book value at the end of the year is the net book value at the beginning of the year. So I can multiply that by my 0.6666 again, correct? My rate. And I'm going to have, again, I'm doing a little bit of rounding, 11,101 depreciation expense at the for the second year. So if I make that a negative, you can see this is why I'm keeping my calculator up. I can scroll across this table. Speed is a skill. Skill gets rewarded. The more you practice this, the more you get good with your calculator keystrokes. I make that a negative, and I'm going to add my 16,667 for my beginning of the year, and I'm going to have a net book value of 5,000. A little bit of rounding is fine. 5,555 at the end of the year too. So this is the key. You can see that there's a residual value of 5,000. So we know we don't have to really go any further than this. We know that's our beginning value, net book value at the beginning of the year, but we're not going to depreciate past the 5,000. So the depreciation expense must be 555, okay? Because we can see with that beginning book value, if I multiply it times 0.66666, okay, you're going to see 3703. No, it's not the 3705. That would be the wrong answer. Do you see that, folks? Because that's what people would calculate if they forgot that you can't depreciate past the salvage value. So that's the key to this one. The correct answer is A. It's 555. We just went through the table, and you can see that you have to remember that you don't depreciate past the salvage value. So a fairly easy question. It's just setting up your table and working quickly through your calculator keystrokes and paying a little bit of attention to detail and knowing that you can't depreciate past the residual value. Good little question. So we'll finish this LOS with one last practice question. A Mexican corporation is computing the depreciation expense of a piece of manufacturing equipment for the fiscal year ended December 31st, 2010, using the information below. The company takes a full year's depreciation in the year of acquisition. So the date of purchase, January 1st, 2010. Cost of equipment, Mexican pesos, 2 million. Estimated residual value, 200,000. Expected useful life, 10 years. Total productive capacity, 5 million units. And the production in 2010 was 800,000 units. So the depreciation expense in Mexican pesos will most likely be A, 180,000 lower using the straight line method compared with the double declining balance method, B, 140,000 higher using the units of production method compared with the straight line method, or C, 112,000 higher using the double declining balance compared with the units of production method. Okay, an excellent little question, very CFA style, where you need to do some calculations. You can see the question is asking you to compare actually the straight line versus the units of production and the declining balance. So you have to be very quick with your calculations. Speed is a skill, skill gets rewarded. So you can see here for the straight line, how do we calculate the expense? Pretty easy. That's our cost, 2 million minus our salvage, 200,000 divided by 10. We're going to get 180,000. That should be easy. And the rate 1 divided by 10 equals our 10%. Our double declining balance, if we skip over here then, is going to be 1 divided by 10 times 2, which is 20%. So it's 20% times our starting net book value, which is 2 million. We're going to have 400,000. So we can compare the declining balance versus the straight line. It's already higher, 400,000 minus 180,000. Okay. Now the next thing that we need to do is calculate our units of production. Again, the numerator is the same as our straight line. It's our cost minus our salvage value, and then we can divide by our total number of units times by our actual number of units, or in this case the formula is written as cost minus salvage value times actual units over total units, and we get 288,000. And then you simply had to bring up your calculator and do the little calculations. That 400,000 minus, you can see 180,000. That gave you the difference for the 222 between the declining and the straight line. You can compare the units of production over the straight line, or in this case to get the right answer, it was the 400,000 minus the 288, which equals the 112, and that was the correct answer was C, 112,000 higher using the double declining balance compared with the units of production method. Okay, so quite an easy question, but it just has a lot of quick calculations, and you can't make any calculator keystroke errors. And that's the last slide for this LOS. Thank you.